In this video, we're going to take a look at CONY, which is the YieldMax Coin Option Income Strategy ETF. There's been a lot of buzz going around about this ETF, particularly on websites like Reddit that have dividend investing communities. I'm sure by now you can probably figure out why a lot of people have been talking about this investment. According to YieldMax's website, this ETF apparently has a dividend yield of over 117% right now. This means that assuming you were to invest $1,000 in this ETF today, and assuming this dividend rate would remain unchanged, you could expect to earn $1,170 per year in dividends. That doesn't even account for any potential gains in share price. So let's take a deep look at this dividend fund and try and figure out how it's able to provide this massive dividend yield and see if it's worth holding for those looking for high income. According to the fund overview, it says, the YieldMax Coin Option Income Strategy ETF, CONY, is an actively managed fund that seeks to generate monthly income by selling/writing call options on COIN. CONY pursues a strategy that aims to harvest compelling yields while retaining cap participation in the price gains of COIN. In other words, despite being an ETF, which is typically designed to hold numerous different stocks, CONY invests in only one company, which is Coinbase. Coinbase Global provides financial infrastructure and technology for the crypto economy in the United States and internationally. They're basically a really popular brokerage company that offers cryptocurrency investing accounts. They're mostly popular among younger people and those interested in Bitcoin and other cryptocurrencies. The company behind this ETF is called YieldMax, who about a year ago exploded on the dividend investing scene with their Tesla covered call fund, TSLY, which I've covered in a previous video. When that ETF came out, it caught the attention of a lot of investors because at the time it was offering a yield of around 70%, which was unlike anything that had ever come out before. In the last few months, YieldMax has been releasing new funds like crazy, almost a new ETF every single week at this point. Some of those include NVDY, which is for Nvidia, mRNA, which is for Moderna, and XOMO, which is for Exxon. All of these funds offer outrageously high yields, anywhere from 12% on the very low end and up to 126% in the case of COIN a few days ago. They're apparently not done coming out with even more ETFs at this point, including one for Berkshire Hathaway stock eventually coming soon. Their About Us section on their website doesn't really offer a whole lot of information regarding their company or where they came from. It says, YieldMax ETFs was founded by ETF industry veterans with decades of experience in income-focused investments, option strategies, portfolio management, fund risk management, and fund operations. Our mission is to create innovative and unique ETFs that solve problems for investors of all types. I think it's odd that they don't have their portfolio managers or board of directors listed on this page. They have a team section, but this is just their advisors, their law firm, and who they hired to do their accounting. But on top of this ridiculously high yield, there's another reason why so many people have been excited about this ETF. Since launching just 4 months ago, it's already provided investors with a total return of 57.73%. That means a $10,000 investment in CONY 3 months ago would now leave you with $15,773. As you can imagine, even with the recent rally we've been going through these last couple days, this ETF is still crushing the S&P 500. Looking at a side-by-side comparison of the S&P 500 ETF, SPY, it's only seen a gain of 6.61% during this exact same time. So a lot of people have been really excited about this fund and its returns it's been able to deliver up to this point. But let's take a deeper look into this ETF and see how it works, because if you've been a dividend investor for at least a little while, this high yield and the return should hopefully cause you to take a second look at this fund. Right away on this fund's page, the first thing it says is, this fund does not invest directly in COIN. Investing in this fund involves a high degree of risk, single issue risk. Issuer-specific attributes may cause an investment in this fund to be more volatile than a traditional pooled investment, which diversifies risk or the market generally. The value of the fund, which focuses on an individual security, COIN, may be more volatile than a traditional pooled investment or the market as a whole, and may perform differently than the value of a traditional pooled investment or the market as a whole. Sounds a little repetitive for some reason. It's pretty interesting that the first thing you read about this fund is how risky it is. In fact, if you go to any page on this company's website, every single one has this really long warning at the bottom. It goes into direct investment risk, US obligation risks, derivative risks, currency risks, price participation risks, and on and on. I've never seen a fund company's website come up with so many warnings. On the actual fund page, it doesn't really give a good description as to how this fund generates its returns. So far we know it writes covered calls on Coinbase stock, but the high yield would indicate something more is going on here. If we compare this ETF to other funds that use covered calls like SPYI and also JEPQ, these investments don't offer yields anywhere close to 117%. So in order to figure out what's going on here, we need to check out the summary prospectus on their website. If we look at page 1 under Principal Investment Strategies, we get our first clue as to what this ETF does. It says, the fund is an actively managed ETF that seeks current income while maintaining the opportunity for exposure to the share price of Coinbase. The fund will seek to employ its investment strategy as it relates to COIN regardless of whether there are periods of adverse market, economic, or other conditions, and will not seek to take temporary defensive positions during such periods. As further discussed below, the fund uses a synthetic covered call strategy that provides income and exposure to the share price returns of COIN, subject to a limit on potential investment gains as a result of the nature of the option strategy it employs. This fund's options contracts provide exposure to the share price returns of COIN, current income from the option premiums, and a limit on the fund's participation in gains, if any, on the share price returns of COIN. One of the things mentioned in this fund's page is that the fund does not invest directly in Coinbase stock. This is what a synthetic covered call strategy is. Unlike every other covered call fund like DIVO, QYLD, and JEPQ, all of the YieldMax funds don't actually own the underlying holdings that they write options on. Instead, according to their documents, they seek to synthetically replicate 100% of the price movements of the underlying security through the use of various investment instruments. The strategies this ETF uses are not only more complicated, but it makes them significantly more risky. In a nutshell, for covered call funds, when the share price of the underlying asset falls, then the share price of the covered call ETF will also fall in a similar amount. But when the underlying asset rises in share price, the amount of share price growth the covered call fund will experience is capped to a certain degree. That's how a normal covered call strategy works. With this synthetic call strategy YieldMax is doing, there's a lot more going on. They have a synthetic long exposure to COIN, where the fund will buy COIN call options and simultaneously sell COIN put options to replicate the price movements of COIN. The call options purchased by the fund and the put options sold by the fund will generally have 6-month to 1-year terms and strike prices that are approximately equal to the then current share price of COIN at the time the contracts are purchased and sold. They also hold US Treasuries for collateral, which is also used with some other funds that are options heavy, like SVOL. Ultimately though, in the case of CONY, when times are good, then they'll be really good, but when times go bad or even moderately bad, then this ETF will suffer much more than the underlying stock. That makes YieldMax funds like CONY and TSLY potentially really great investments if you only hold them while the underlying stocks are soaring. I wouldn't recommend anyone buy and hold a YieldMax fund for a long period of time. A good example to look at is NVDY, which is the YieldMax Nvidia stock. You can see on this chart when NVDA is soaring, then the YieldMax ETF only sees a tiny bit of growth in share price. But when the share price of Nvidia falls, then the YieldMax fund falls in an amount almost identical. I've been pretty concerned about NVDY for a while because if you look at Nvidia's stock history, it's likely in a pretty significant bubble. If the share price of NVDA falls by, let's say, 50%, then the YieldMax fund NVDY is going to get obliterated. The exact same thing can happen with Coinbase. Their stock plunged from late 2021 to late 2022, losing over 85% of its value. If this happens again, then CONY is going to get demolished. So like I said, when times are good, then they're going to be really good, but when times get bad, it's best to run for the hills. As interest in crypto picks up again, it is possible that CONY could potentially keep doing well, but I'm definitely not going to make a prediction here. But if you buy it, you have to know when it's the right time to dump it before it all goes through another serious share price decline. And if there's one thing I hate doing, it's trying to time the market. I never like to do short-term trading in my accounts. I like to buy and hold for long periods of time. So I don't recommend people do this, but I won't deny that if you are willing to take the risk, as we just saw, the profits can be exceptional. I don't recommend YieldMax funds for passive investors or retirees living solely off dividend distributions. The dividend amounts change significantly from month to month and you can't even plan a budget around them. But like I said, these are extremely risky and I have no interest in holding these funds myself. As always though, come to your own conclusion on how much risk you're willing to tolerate in your portfolio. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.